Finance Footnotes. I'm Brent Stransky, joined by my friend and colleague, Zach Miner. Today, we're going to break down some of the happenings of the marketplace and the economy, give you some great takeaways, actionable to help you become better investors. Zach, what do you have planned for us today?
I'm gonna bounce around a little bit. A few different themes that I came across this week. No real through line, but a couple interesting things that wanted to put in front of everyone.
Great. Well, it'll be entertaining as always. So let me kick things off here. I want to start with just a bit of where the heck are we? So the first chart here that I am pulling up, this is from the Wall Street Journal this morning. It's showing you the three primary indexes, the Dow, the NASDAQ, and the SP500. And if you look here, I meant to put an arrow on this, but the middle chart there is the S&P 500. You'll see that when did it have its last all-time high? Well, heck, that was yesterday. So we are at all-time highs on most of the major market indices. I think a lot of people are wondering how long that goes for. I think that's the primary question I'm getting from folks is what's going on and how long will it continue to happen. We're not soothsayers, though we try to look into the future and give some reasonable outcomes, Zach. So first thing I want to start with, I'm starting here, folks, everyone at home, with three relatively optimistic bullet points, and then I'm going to bring us back down to earth, okay? But the first one here, this is a great chart. This is from our friend Ryan Dietrich at Carson Wealth. We've mentioned him before. He had some great research that came out this week. We are on the precipice of 5 months of positive outcome on the S&P 500 in a row. That's not very common. So we were up the first 3 months of the year and also in November, December. It's only happened 28 times going back to 1954. But interestingly enough, 26 of those 28 times, or 93% of the time, the S&P 500 was higher in the 12 months following. And I think this is something speaking about the momentum in the marketplace at the moment. Things were obviously very mispriced going back to October when we had 3 down months in a row, which is also a very rare thing. Now we've had, presumably the market will end here in a couple of days. The quarter will end, and so too the month. Markets on average higher 26 or 28 times going forward with an average return of 12.5%. Zach, did you see this figure? Did you see this chart from?
Yeah, and I'm kind of just looking through the dates here, and I don't see too many kind of in the context of a big bounce off a bear market bottom. So I was kind of looking for, there is one 7/31/2009. Not too much like 2000. There's really none 2000, 2001, 2002. Kind of like, intra bear market rallies that you can have like big spikes. And I know in that 2000 to 2002 period, there were multiple like 20, 30% runs in the context of a downtrend. But it looks like most of these are really in the context of an uptrend, right?
Exactly. And
right.
So I peeled back the data too, but for a different reason. So if we turn to the next slide, and I think here on Finance Footnotes, to my knowledge, we're the only ones who have done this. So this is preliminary research here for you folks at home. This is what you're paying us for on this free podcast. So I was curious. I think the next question logically is, well, how many of these were in election years? Okay, so actually look back here and found out that of the last 16 presidential elections, 7 of them were actually a year that had 5 months up in a row. So I thought this is interesting. About half the time, right, during an election year, you saw some stability in the market where things were settled enough to have 5 months in a row that were positive. So I don't know what we can take away from that other than, half the time during a presidential cycle.
Yeah, not sure if that's correlation, causation, or what, but that's some deep cross market analysis there. That's pretty interesting.
Only the most intelligent commentary here at Finance Footnotes. So I thought that's interesting. I think it builds into our commentary. 2 weeks ago, we had a quote from Dr. David Kelly, who we both revere, and he said something along the lines of, don't do anything. A lot of smart Republicans lost money when Democrats get elected and vice versa. Stay the course. And I think that's the point that is borne out here by the 7 of 16 occurrences. So just food for thought for you. I think it's cause enough to stay invested. I think markets, there's a lot of momentum, and that might be a variable enough that drives markets further. We talked about these next 2 bullet points in our previous podcast. I just want to mention them again. Since 1950, when January and February are positive, they both speak to momentum here. 27 for 28 times, the mark was positive throughout the rest of the year. And then 25 for 25, when December, January, and February are positive, S&P is up in the next 12 months, 25 or 25 times. So we talked about this last time. Altogether, 3 really, these are great data sets. These, some of these are 70 or some of them are 90-year-old data sets. It's showing there's a lot of momentum in the marketplace at the moment. So despite what you read on the front page of the newspapers, momentum is a powerful force, and it will be volatile. And that's my next slide. We've talked about this before. And I just want to highlight, the market is a machine that takes money from one person and gives it to another. So we have to avoid emotional decisions. Zach, you've pointed out, I think you may pointed this out even a month ago. This is from JP Morgan. This is the showing you intra-year declines from peak to trough, right? And the point I want to make here is going back to 1980, the S&P 500 stock index, which is the gold standard of U.S. stock indexes. On average, of those years going back to 1980, which is 40 years, if my math is correct, 14% average intra-year decline. So we should plan for a drop here, right? It's on average, there's a 10% drop or greater in the average year. And I just, we get complacent when things kind of coast upwards, and we need to remind ourselves that things can shake out. That's normal and healthy.
Absolutely. And this is one of my favorite charts to always kind of show clients to kind of peel back the averages, because even though over these past 44 years, the market averaged at about 10%, there's very few 10% bars, right? If you go through and look through there, like most of it's not 10%.
Yeah, I don't see any 10%. Oh, there's one 10%.
Yeah,
2015.
2015. But usually it's, up quite a bit, big drawdowns in between. So kind of volatility is the price of admission to get to that average annual return. And so this is a good level setting chart to just show folks that this is how you get to that ultimate average level is by volatility.
Yep. And so I've waxed on here for 10 minutes, relentlessly refusing to take a breath. But the 2 points I want you to take away here, folks, is that volatility is, always available in the marketplace. We should expect on average a 14% pullback from peak to trough in any given year. And, I gave 3 bullet points as to why I think, in 12 months from now, things could look positive. But the final point I'm making here is that it's going to be choppy in the meantime. So we have to stay the course. That's the nature of investing. 2 other slides I want to make, points I want to make, and then I'm going to hand it over to you, Zach. Interest rates, what could derail, what could improve volatility? And I think it has to be the conversation about debt and interest rates. I have a 20-year chart here. This is pulled from the Federal Reserve Bank of St. Louis. And you're just looking at the 10-year chart here. This is the interest rate. And you can see here that in 2020 during COVID, it was less than 1%, but we're coming back to 15-year highs on the 10-year treasury. It's been bouncing around a fair bit, and stocks seem to be in lockstep with what happens with interest rates, because a lot of their debt is tied to, what happens in the interest rate market. Interest rates go up, their debt burden increases, et cetera. So that would be what I'm most curious about going forward that could lead to volatility. And Zach, you probably agree with that. That's a pretty common thing in the marketplace that's been discussed.
Yes and no. I would actually push back a little bit on it, because
go ahead.
Because if you look at kind of the underlying themes of the market, like what's happening. So the expectations for rate cuts are plummeting, right? I mean, we were pricing in almost 100% chance of a rate cut in May. Now it's essentially off the table. So the expectations for those rate cuts are dropping. The market is still achieving all-time highs. The most interest rate sensitive area of the market, small caps, are starting to participate. There's more breadth in the market. And so you're kind of actually seeing a decoupling of the correlation between interest rate moves and the markets, which is what you really have had over the last kind of 2 years. It followed it on the way down as interest rates went up. And then as we got to the point where we were expecting the interest rates to top out, the market began to participate to the upside. You would think that over these last couple months, as it looks like, hey, maybe they're going to go slower. Maybe they're going to be higher for longer. These interest rates are maybe a little stickier. Inflation's kind of not quite getting down to where they want it to go, right? You would think that markets would potentially have had a pullback, especially because everything we just talked about, it's due, right? We haven't had a pullback. So it would be an easy reason, right, for that to happen.
Would. And as correct as you are, last Wednesday, the Federal Reserve Chairperson, Jay Powell, your personal friend Jay Powell, he said, listen, we're still on course for 3 cuts this year, and the market rallied significantly last week and into this week. Sure. So folks, it's reason enough to continue to tune into your number one source of information here on Finance Footnotes. The market's changing.
My speculation is that if it continues to decrease in chances, like if they don't do 3 this year, right? That's kind of where I think you do have to have some sort of, kind of reversion back to the correlation between those two things. But as of right now, I think it just indicates the strength of the underlying economy and these companies' earnings. especially if you're looking at small caps, because those are companies that are much more interest rate sensitive, and they are really starting to participate. And they're starting to participate. Small caps are starting to go up on days where the indexes are down, and that's a really interesting signal for underlying broad economic strength. Is that they're kind of leading it. Even if the S&P is down 30, 40 basis points, I've seen days where, the Russell's up 1%, right, on those kinds of days, which is really interesting.
Very interest rate sensitive.
Tells us something. Yeah.
We'll have to wait and see what happens. Of course, it's always exciting to pay attention here. All right. So the last slide, just a quick update here on the politics of the day. Of course, this is a big election year, as maybe you're aware of at home. I don't know if you have a TV or live under a rock, but there's an election this year. And just one point that was in the Wall Street Journal. This is an op-ed from one Karl Rove, who was a political specialist for, I believe, G.W. Bush. And, he was just pointing out that, listen, the Democrats hold a very slim majority in the Senate, which is the upper house, the most powerful house, 51-49. But they're defending 23 seats in this year, right? A third of seats come due every 2 years. The Republicans are only defending 11 seats. And the speculation is there will be a pretty high likelihood that there's a shift to a Republican-led Senate, if nothing else. So, everyone's talking about the headline race, but, underlying that is the Senate race, which it seems to suggest high likelihood that it will skew to a Republican-controlled Senate in 2024. So that being said, friends, I would hand it over to my colleague, Zach. Zach, what are we talking about today?
Yeah, the first thing I want to just take a look at, and, we've had that horrible bridge tragedy over the last week in Baltimore, the Francis Scott Key Bridge. Now, this wasn't a failure of the bridge; a ship ran into it, but it did just kind of get me
hard
thinking,
to predict that's going to happen. I don't know if you saw Lloyd's of London. Lloyd's of London said they were their big reinsurer, and they said possibly the biggest single payout for commercial catastrophe of this nature.
Yeah, and it was just something that obviously you can't predict that in any way, shape, or form. And luckily, I know lives were certainly lost. It was at 1 a.m. They were able to issue a mayday, stop traffic.
Gosh,
I think that could have obviously been a much bigger tragedy. But it did start just, getting me thinking again about infrastructure. And this is something that the country is going to have to contend with because it's all getting old. Now, this particular situation was not a failure, but we have had bridge failures over the past several years. There was one, I believe, in the Minneapolis area a couple of years back where people lost their lives, and that was a true collapse. But levees, dams, bridges, roads, all of the infrastructure that makes our economy go is getting old. Private fixed assets, public fixed assets, government power, highways and streets, we're talking 25, 30-year-old infrastructure, some of it much older than that. And you can kind of see after World War II, we had the big infrastructure build of the 1950s, and that really started to, put a lot of that stuff, up to the modern standards of that time. But a lot of it's still from that time, and they've patched and they've paved over and they've tried to, stick, things back together with some welding and some tape.
I don't think anyone in Pennsylvania is surprised as learning that government highways and streets are approaching their highest age of all time.
Yeah, and so I think this is just, it interplays into the budget and the deficit conversations because we start thinking about where are we going to get this money and the amount of money that's going to have to go into this infrastructure. It's critical. This is almost as necessary as Social Security at a certain point, right? Maybe not today, but within the next 10 years, we're going to get to a point where we're going to have critical systems failing, and we're going to have to update it. So I think just, we're going to have to really start to contend with this as a society and in government, because we're going to need probably trillions in order to adequately update our infrastructure in order to power this economy. Because if you can't ship things and you can't have reliable bridges and reliable roadways and reliable ports, then you're going to not have a very reliable economy.
Yes, exactly.
Any thoughts on our infrastructure out there?
No, I just, listen, do I want to talk about this? No, but it's in the background and it needs to be repaired. It's an investment, not only in our society, but in our future society, right? You want to have an infrastructure in place for the next generations, right? But the first thing that comes to mind is, as I'm sure everyone who's reading, listening to us at home, the budget. Where are they going to pack this into the budget? And what other expenditures should the government be prioritizing other than infrastructure? Right. It's just it's tough. It's a tough question.
Yeah, it certainly is, and it all of these things play together because higher interest rates is more more interest cost. You've got aging population, is more Medicare cost and more Social Security cost. Combine onto that with 40-year-old bridges and highways, right? So it's you have all of these competing priorities. So, and they're all important. And so I think it's going to be something that we're really going to have to contend with. And as capitalists and as folks who want a booming economy, we this should be a pretty high on the priority list.
Yeah, we'll have to see who puts it on the budget item here going in the future. We'll see.
Yeah. Next, I want to just bounce to something that we really kind of just touched on is just the days since the SP 500 decline of 2%. Not many times where it gets this long. It's been 271 days as of...
Yikes. I didn't realize it was that long. Holy smokes.
It's been quite a while. We had one back in... If you remember the glory year of 2017 where just the market really just didn't do anything except slowly and methodically chop up. We're kind of in that mode right now here in the third and fourth quarters of fourth quarter of 23 and now the first quarter of 24. Certainly due for some volatility. It's just we're at the second longest going back to 08 or 06. Don't be surprised.
This is really surprising, and I love the name of the chart. Long in the tooth. Yes, they look like teeth, and they should. But clever is always my friend. But the first thought I had is there, and just to dig a little deeper here into the peeling back of the onion. I feel like there's been some talk about this in the journal and other places about how much option strategy play there's going on in the market at the moment. Insurance companies, structured notes, et cetera, gaining popularity. They are hedging their bets with the long and short, call option strategies, which is something I believe is called delta. I'll ask the CFA in the conversation, delta hedging. And I believe that has the implied tendency to reduce volatility until it doesn't, right? And that's the fear is that, we're going 271 days, but then, if there is a event that shakes things out, it's going to be a good one.
Yeah, for sure. And that, it does tend to dampen volatility until it goes outside of those bands, right? And then those positions unwind. And then you kind of have situations where it accelerates,
Yeah, that's you go from delta hedging to CYA.
Yeah,
ASAP.
And so, whatever that catalyst is and whatever it may be, I think that we're just in that situation where, look, it's been quite a while since we've had a volatile day.
Yeah, great chart.
And the next one kind of just goes a little bit what you were talking about is just kind of the changing nature of the market and how much trading is being done. You have 0-date options. You've got
oh my god, this is a great chart.
It's just the things are different. And I always like to go back to these kinds of charts when a lot of times we're doing 50, 60, 70-year historical comparisons. And it's like, it doesn't really compare because it's a different market. Not only are the makeup of the companies, and we talked about this before, is, what the companies are actually doing, right? And how they're earning their revenues and, what kind of goods and services they're providing is wildly different. But the participation in the market is wildly different, and how people participate in the market is wildly different. The average hold time for stocks in the 60s and 70s was like 5 years. Now it's less than a year, right? That's a huge difference in how market participants are acting on the equities in the market. And so,
and if I could just jump in here real quick, I think you'd agree, Zach, that if you want different outcomes than everyone else, you have to do things differently, right? And if all of your neighbors are holding on to stocks for 3 or 6 months, holding on to them, like taking the Warren Buffett approach, is a different style, it's a different strategy, it's a different approach, and it will lead to different outcomes. And that's probably not a bad idea.
It's interesting that, long-term investing, it's always been kind of the mantra, right, of folks who, want to have the best outcome. And, in our business, and we always try to preach long-term investing. And it's kind of like, it's kind of a contra trade right now. It's kind of like it's something that not, most of the market is doing. So you're certainly right. Being a long-term investor is actually kind of a differentiated strategy at this point.
Buy and hold. Yeah. It seems crazy. A great chart. My God, I didn't realize this. Holy smokes.
Yeah, for sure. And I am wondering about the kind of pre 1950. It seems to bounce around a lot. I guess there's definitely some wars in there, and I don't know. I don't know why that's so, volatile. It goes from like 6 years to 3, and like within a couple of years. And
you wonder how often they were taking these data samples and how they were measuring it, pre-computers.
Right.
Anyway,
I think that's probably something happened to it. Yeah. The next, I just wanted to go into. I had a conversation with someone at a conference I was at recently about why is the Federal Reserve saying they're going to cut rates? Why? Because if they're data dependent, well, the data really doesn't say they should cut rates. Economy's good. Inflation is still kind of hot. We're not really there yet. Why are they cutting rates? And 1 year out from last year's, commercial regional banking crisis that we had, I think maybe this is partially the reason, is that there are a lot of corporate real estate loans at these small banks that if Jay Powell and the Federal Reserve System is well aware of, I'm sure that they have eyes and ears into all of these banks, and they know what their balance sheets look like. So my expectation is that they can't really withstand high rates for many more years, and that at a certain point that the Federal Reserve is going to kind of have to start lowering borrowing costs so that when these rates start to roll, when these loans start to roll over, they're not going to be in a position where, they're going to be underwater. And I think a lot of these loans have been modified. They've been pushed out a little bit, into 25. You're getting a lot of those extensions, interest only extensions, modifications, to kind of extend the runway of a lot of these things, because no one wants a property to be handed back to the bank, right? The bank doesn't want that. The owner doesn't want that. Nobody wants that. But I do think that at a certain point, you can only extend it for so long, and the musical chairs will have to run out. So,
well, for those of you who are listening and not watching the podcast, this is a really great chart. And what it's doing is showing on the left-hand side, there's probably 100 dots on the screen, which represent, smaller banks. And then, on the far right are the larger banks, right? And you can see that from this chart that the vast majority of the small banks have as much commercial real estate debt as the big banks. So I think it's a great chart if you can't see it. But yeah, wow, there's a huge skew there in the data.
Yeah, the big banks don't really get too involved in commercial real estate. I mean, they're involved in it, but that's not their main business line. The smaller banks, that is usually a main business line of them. Most of the commercial real estate in the country is serviced by smaller regional banks. And so those are banks that don't have other sources of revenue. They don't really have, trading desks and, all of these, structured product issuance and wealth management divisions that are, contributing quite a lot of capital and revenue to them. So they don't have things to fall back on necessarily. And so I saw this chart after this conversation because we were talking about it in the context of like, Jay Powell's always been a pretty, at least, as stand up as he could be. He's always been very forthcoming with what they're going to do. Mm-hmm. And we're just like, well, why are they going to cut? The economy's pretty strong. The labor market's strong. The inflation's still high. Like what are all of the things that, they have kind of said indicates that they really shouldn't cut. And we were kind of talking about like, okay, it's an election year. He doesn't want to be seen as being political. Okay, that makes sense. But then I saw this chart and I was like, well, this actually kind of makes more sense. Is that he kind of has to know some things.
I worked at a bank for many years before I came to LPL Financial and Independent Square Advisors. And I think it's a mistake to assume that the lending committees at these, small and mid-sized regional banks are very rational actors. I mean, for example, if you look at First Republic Bank here in California, that had some issues, and there's Silicon Valley Bank, of course. More importantly, if you look at the Silicon Valley Bank as to why they went out of business, and you look at the interest rate risk they were taking at the absolute bottom of interest rates, it's really dumbfounding that these are very smart people, and they were not acting rationally. And if you have a minute, take a look. You may be dumbfounded to see you can find it on the internet, what drove that bank into failure. Shocking that they would take that amount of risk at that point in the market. But that's what's happening, and that's what, to your point, Jay Powell is probably considering.
You're 100% right. It was the most telegraphed interest rate move in history, that the 2022 rates were going to go up, and these folks did not hedge properly.
They took on excessive risk and leverage at the exact wrong time. It's crazy. Yeah. But But I guess, at the Federal Reserve, when you're sitting in ivory towers, you're watching these people make these irrational decisions. You have to protect the market. And yeah, great point, Zach.
Yeah, interesting. And the final one, I always like demographics. I think the demographics is kind of the story of the future. And, what does the future of our economy look like? Well, it's going to look like the people that participate in it. And this one, this is just one of those things where I'm like, what's happening here? You have more people graduating high school. This is a chart that goes back 1970 to 2023. It looks at high school.
Wow, this is fabulous.
High school graduation rates on the right-hand side and the average SAT score on the left-hand side. And you've got a kind of a dumbing down of the, based off of SATs, for a skyrocketing rate of graduations. And it's like, it's just like the participation trophy mindset. And it's just passing people through the system and like, hey, whatever, everyone gets an A and you're all going to graduate and you're all going to be fantastic. And all these people are going to be running the economy at some point in the near future. And there's a huge spike at 2010, a huge divergence at 2010. It kind of was pretty stable between the 1970 and 2010 when both of us were in college and high school. And it radically changed after 2010. Now you've got going from 75% high school graduation rates to 85+%. It's just I don't necessarily have any like commentary on it. It's just one of those things to point out that the workforce of the future is going to look and act different.
Yeah. Wow. What a chart. I do know I've been highlighting to folks in my newsletter that, ACT, SAT scores have been, lowering for the last 10 or 20 years for these purposes. I think it's difficult to be a kid with social media and other elements at the moment, but yikes.
For sure.
Good point. Wowzers.
Interesting. So I'll leave you with that little demographic downer. But it's interesting, I know a lot of colleges had taken away the SATs.
Starting to add them back now, though.
They're adding them back. They're putting them back in because they're realizing we made a mistake. Like we actually have to have some objective way to measure, the people that we're bringing in. And that's not to say that the SAT is like the most important metric there is, but it is a metric that should be considered, right? So interesting.
Well, for all you teachers out there, thank you for everything you do. I know it's a harder time than it ever was. Please keep up the good work for our society's sake. Well, Zach, what a great conversation. I know we kind of pieced together here a Frankenstein set of slides, but man, this is intelligent stuff, folks at home. This is good stuff. This is why you keep coming back. We mentioned delta hedging in the conversation. I've been waiting for months to bring that in. I'm so excited about that. We brought in optimistic notes here for you, but reminded you, hey, you got to stay the course. Things will get choppy. That I promise you. So we'll look forward to seeing you again in a couple of weeks. As always, if you have questions, please feel free to reach out, and we'll see you next time on Finance Footnotes.